Chairman, let's talk about the how we measure the success of these emergency liquidity programs. We heard, members of Congress heard from market participants that TALF in particular and the corporate credit facilities were a psychological backstop, and even if the utilization wasn't there, that there was that the markets weren't seized, that they actually functioned because there was this psychological backstop that was there. And so I mentioned in my opening statement, it's important that we grasp how to measure the success of these facilities. Looking simply at utilization or take-up makes them perhaps look unsuccessful, but a broader look at the market and credit conditions in this unprecedented economic shutdown and evaluating it through the lens of the Fed serving just as a backstop, but not as necessarily a provider of credit, might indicate that they were successful. So, Mr. Russo, how would you evaluate the performance of the Fed's facilities, and what metrics should we actually use to judge their success?
Congressman, thank you for that great question. As an economist, I think it's important to look at the benefits of a policy as well as the drawbacks. So one thing that hasn't been mentioned already in terms of the drawbacks of such a policy is, first, there's only so much real economic savings to be allocated. Again, that's all the Fed can do. They can allocate savings. So when the Congress or the Fed or anybody else decides to allocate more savings to New York and Illinois, they're taking it away from somewhere else. You don't see where, but that's a real drawback. Second thing I'll mention is that by trying to peg prices, in this case an interest rate for credit, you do make some better off and some worse off, like any subsidy. So, for example, Illinois got better rates if we buy the arguments that were put forth before on its municipal loans. That gave a worse return to the pensions that own those bonds or that finance that new investment. So again, I think there's a complicated cost benefit we could do here, but I would just remind you of those other sides of the ledger. And again, this is not really the Fed's role to be doing credit policy.
Yeah, let me stick with you and that point that you're making. Some of our colleagues have suggested that the Fed should take a more active role in addressing social or environmental issues. Some have even gone as far to suggest that the long run changes in weather patterns due to climate change are emergencies and thus necessitate the Fed using its 13.3 emergency lending powers to directly finance green energy. Mr. Russo, what would the impact be on the Fed's independence if it strays outside of its mandate and actually took a more active role in social and environmental issues?
I believe that its independence would be irreparably damaged, and in doing so, it would weaken its independence and its effectiveness in the next crisis.
Mr. Russo, I want to ask you now about the penalty rate. Some have contended that the terms and rates, and some of your fellow panelists here have contended that the terms and rates of some of the Fed's facilities are too onerous, resulting in lower uptake if prices were more aligned with market rates. As you know, the Fed is required by regulation to charge a penalty rate at a premium to market rates in normal circumstances. This is in part to ensure that the Fed maintains its role as a backstop and provider of liquidity rather than replacing private markets. What impact would an adjustment to the requirement of the Fed to charge a penalty rate have on its role in the economy? And could that change its role from a backstop to a direct competitor with private entities?
Not could, would, sir. Thank you again for that question. To give you some context here, the Fed's loan to Illinois, that was a direct loan, had an interest rate of about 3%. We've seen the inflation in the last year in real terms, not dollar terms, but in real terms, inflation adjusted, that's a negative return. And so just to summarize, when we reduce any of those 5 criteria I set out for a lender of last resort, you no longer have a lender of last resort, and that includes getting rid of penalty rates.
Yeah, I think preserving the role as lender of last resort is very important and not displacing the private sector. Final question to Mr. Russo. In the 115th Congress, when I chaired this subcommittee, I sponsored a package of Federal Reserve reform bills, which included a bill called the Congressional Accountability for Emergency Lending Programs Act. Mr. Hill was part of this effort. The bill would require the affirmative vote of a greater portion of the FOMC than is currently required. It also required an enhanced role from Congress to authorize these emergency lending authorities. Of course, the CARES Act did interject the Congress in approving some of the emergency lending that we saw in the pandemic. But what are your thoughts on a bill like this to strengthen the congressional role, to limit the Fed's emergency lending powers, not eliminate 13.3, but just provide a little better accountability, involve more of the members of the FOMC in this.
Thank you, sir. I believe that Congress plays an important role in the oversight of the Federal Reserve. I can't comment on that legislation specifically, and I don't endorse legislation, but I'd be happy to work with your office on these issues going forward if that'd be helpful.
Thank you, Mr. Chairman, for your indulgence. I yield back.